Inflation is a problem. It's on top of mind right now for many consumers, businesses, and investors. On an individual level, it causes harm to consumers at no fault of their own. It eats away at workers' paychecks and precious savings. Inflation in the United States has shot up 8.4%. It's the highest it has ever been in the last 41 years, but the media might be downplaying the inflation numbers. Today I will be talking about why the media misrepresents the real inflation data. Stick till the end of the video to find out how the inflation in the United States is actually 17%. Let's start from the beginning. In the 20th century, the federal government began a series of steps to expand the money supply to boost more expansive federal spending. One of them was the end of the gold standard. The gold standard is a monetary system in which the value of a country's currency is based on a fixed quantity of gold. In practice, central banks made sure that domestic currency, which is paper money, was easily convertible into gold at a specific fixed price. Gold coins also circulated as domestic currency alongside other metal coins and notes. President Richard Nixon closed the gold window in 1971 in order to address the country's inflation problem and to discourage foreign governments from redeeming more and more dollars for gold. This enabled the expansion of the money supply. Over the years, printing money has become a habit for the Fed to the point where now they print money directly into the Treasury. And the excessive printing of money causes inflation to rise. But how does the printing of money cause inflation? Well, inflation is caused when the money supply in an economy grows at a faster rate than the economy's ability to produce goods and services. In other words, if you put too much money in circulation, the value of money decreases. It's never the rising prices, it's always the falling currencies. Your chicken steak has the same value as before, but the amount of paper money required to purchase it has increased. By the way, are you enjoying this video? Please give it a like and hit the subscribe button if you like content about the business, economy, and crypto. It really helps me grow the channel. Now back to the money printing. To hide their tracks, the Fed changed the meaning of inflation to rising prices rather than an expansion of the money supply. It's exactly as the Nobel Prize winner for economics Friedrich von Hayek once said. I don't think it is an exaggeration to say history is largely a history of inflation, usually inflation engineered by government for the gain of the governments. Government policies like the Federal Reserve's printing of trillions of new dollars to fund COVID stimulus efforts had big economic benefits, but it also fueled inflation and the consumer prices are rising in alarming ways. Just look at the US Federal Reserve's balance sheet and decide for yourself. Does this look like they have anything under control? Since the 2008 Lehman collapse, the Fed's balance sheet has increased tenfold and continues to reach new all-time highs every month. And keep in mind that the situation is no different in Europe, Japan, or China. All major central banks coordinate their quantitative easing programs and issue money at comparable rates. As a result, the Fed, BOJ, and ECB boosted their balance sheets sixfold, from $4 trillion before 2008 to $24 trillion in 2021. The first round of quantitative easing in 2009 was an emergency move to keep the economy from collapsing. On the other hand, the ones that followed were no longer emergencies. Without a doubt, money printing has now become permanent. As a result, central banks can never reduce their balance sheets, raise interest rates, or terminate their QE programs. The entire system looks like a house of cards on the verge of collapsing. Central banks already have enormous levels of debt, which is worsened by a bubble in the bond, stock, and real estate markets. From time to time, they like to threaten to normalize the monetary policy. However, if they do, the entire credit market will stop, and that would be chaos-inducing. In a nutshell, central banks' balance sheets will grow by trillions of dollars per year, and it's difficult to imagine any scenario that would lower inflation. These days, you might have read or heard one phrase many times: inflation is transitory. What does that mean? The Fed considers recent inflation spikes to be transitory, and all major central banks quickly adopted the same talking theme. The meaning of transitory is temporary. However, the Fed refuses to provide a specific time frame. Is 5% inflation transient? If it had been there for 5 years, what if it lasts 10 or 20 years? Nobody can prove that the current inflation is only temporary. The term transitory is being used by central bank officials and pundits to downplay the alarming levels of inflation. In reality, central banks can only make inflation transitory by changing inflation calculation methods, as they have done in the past. For example, the US government changed the method in 1980 to deliberately downplay inflation risk and manipulate public opinion. If we're using the US Bureau of Labor Statistics' original calculation methods, the true inflation rate is around 17%, not 8%. In 1990, the Fed again evolved the Consumer Price Index so that these tricks for downplaying official inflation were exacerbated. Unfortunately, the major media reports whatever Washington feeds them, as if this shape-shifting measuring stick is actually useful to consumers. As you can see, inflation data has become controversial. Fortunately, consistent data is available on Shadow Stats, where economist John Williams updates inflation data using the Federal Reserve's original CPI calculator. Most of the data is behind a paywall, but you can still see how the official Fed statistics are now somewhat less than half of what they would be if the CPI tool used up to 1980 was still in use. The first percentages are the official CPI numbers. The percentages on the right are inflation using the original measuring stick. As you can see, this year the real inflation numbers are slightly more than double the official numbers. US annualized inflation just peaked at 17% for the first time since World War II, which is the highest rate in 75 years. This year, Americans might lose 20% of the value of their paycheck through inflation alone. The Fed continues suppressing interest rates and was still printing money last month. The crisis will only diminish once Congress decides to stop spending and the Fed jacks up interest rates to unforeseen levels, the effects of which will be a huge recession. Gas prices are already up by 48%, used cars are up 16%, and food is up 10%. You get the idea. The Biden administration's number one enemy right now is inflation. And they do not want a recession on their watch, so they will most likely try to cover up the situation with more subsidies, which, as we all know, only makes things worse while delaying the inevitable crisis. There is significant evidence of inflation right now if you just look at what's happening to consumer prices, yet the media continues to downplay the significance of what we're seeing. Maybe they know something we don't, or maybe they are doing what they are told to do by someone above their pay grade. But it is crystal clear that one way or another, the media is misreporting inflation. Right now, the economic situation is bad. We are going through an economic downturn. But what about the future? Well, chief executives of some of the country's top companies are also getting really worried about the economy. Tesla CEO Elon Musk and JP Morgan Chase CEO Jamie Dimon have already said that a recession is coming. And do you know what's the worst thing about this? Inflation always hits the poor hardest. During times of economic instability and recession, most households tend to avoid buying luxury products. But people can't cut back on necessities like groceries and heating, while wealthier customers are better equipped to stock up on them when costs are low. This shift in spending from luxury items like vacations and new cars to necessities pumps up inflation for poor families more than for richer households. This is because lower-income households spend a larger amount on their income on necessities. The wealth gap between the rich and the poor widened last year. This means inflation is even harder on the poor than it was before. This is the new normal, and people across the world suffer the consequences of price inflation when their paychecks don't stretch as far as they used to. Instead, make sure you choose the best path suited for your survival. It's nearly impossible to survive inflation for someone who owns no assets. The more assets you own, regardless of whether it's equities, real estate, Bitcoin, etc., the better off you will be. The 2008 recession lasted for 18 months. How long will this economic slowdown last? Let me know in the comments below. If you learned something new from today's video, click the subscribe button and hit the bell icon to be the first to see my next video. I make deep dives like this every week where I uncover the secrets of money and business.